This is Marco. And Marco has a problem. See, Marco did everything right. Saved his bananas, opened a brokerage account, watched the right videos, read the right threads. Diversified like a responsible adult monkey who actually paid attention in economics class. And for a while, things looked great. Portfolio green, net worth climbing. Marco even started telling his cousin at family dinners that he knew what he was doing. Then 2026 happened. And Marco, like millions of other monkeys, is now staring at a screen full of red numbers, wondering where exactly everything went wrong. Because the signs were there. All of them. Sitting in plain sight for anyone paying attention. But Marco wasn't paying attention. Marco was watching the numbers go up and assuming they would keep going up forever, because that is what monkeys do when things are good. They forget that things have never stayed good forever. Not once. Not in the entire recorded history of monkey civilization. So what exactly is happening to the market right now? Why are serious financial analysts quietly preparing for something ugly? And more importantly, what does this mean for Marco's bananas, your bananas, and every monkey who worked hard to save something worth protecting? This is the 2026 market bubble, explained. But before that, let's establish something important. Because when monkey hears the words market crash, the brain immediately goes to 2008, Lehman Brothers, monkeys losing houses. Retirement accounts cut in half overnight. And yes, that was genuinely catastrophic. But here's the thing about crashes. They do not all look the same. They never announce themselves politely. And they certainly do not wait for monkey to feel ready before arriving. Because what is building in 2026 is not one problem. It is 4 problems sitting on top of each other wearing a trench coat pretending to be a healthy economy. Problem 1. The debt number that should terrify every monkey but somehow does not. United States boss monkey currently owes 34 trillion green leaves. That number is so large that if Marco tried to count it 1 leaf per second, he would need 1 million years to finish. His grandchildren's grandchildren's grandchildren would still be counting. But here's the part that is actually scary. That number is not the problem by itself. The problem is the direction, because that number has never gone down, not once in recent memory. Boss monkey borrows more every single year to pay the interest on what was borrowed last year, and then borrows again to cover the interest on that. This is not a budget strategy. This is a monkey standing in quicksand deciding the solution is to jump higher. And Marco is not imagining this. Interest payments on the national debt in 2025 crossed 1 trillion green leaves annually for the first time in history. 1 trillion, just in interest. Not paying down the actual debt, just the interest bill, every single year. At some point, the math stops working. And when the math stops working for Boss Monkey, it stops working for every other monkey downstream, including Marco. Problem 2. Corporate debt coming due at the worst possible time. For 10 years, companies borrowed cheap. Interest rates were so low that borrowing felt basically free. Companies loaded up on debt, bought back their own shares, made earnings per share look fantastic. Executives collected enormous bonuses. Shareholders cheered. Then rates went up, sharply. And now those cheap loans are expiring. Companies need to refinance. Except refinancing in 2026 costs 3 times what it cost when the original loan was taken. Some companies can handle this. Others quietly cannot. And the ones that cannot are not announcing it loudly. They are hoping something changes before the bill comes due. Corporate debt defaults in 2025 hit the highest levels since 2009, not approaching those levels, at those levels. And the companies defaulting are not tiny startups. They are recognizable names that Marco probably has in his portfolio right now, without realizing the foundation underneath them has been cracking for 2 years. Problem 3. The consumer monkey is completely out of banana credit. After the big virus shutdown, Boss Monkey sent free green leaves to every monkey. Consumer monkey spent enthusiastically. Economy looked strong. Retail numbers looked green. Victory was declared loudly and repeatedly by people in expensive suits on television. But the free leaves stopped, and consumer monkey kept spending anyway. On credit, American consumer credit card debt hit 1.3 trillion green leaves in 2025. Delinquency rates climbing every single quarter. Late payments on auto loans at decade highs. The consumer spending that has been propping up the economic numbers is not real spending power. It is borrowed spending power. And borrowed spending power has a return date. When consumer monkey stops buying things, the companies selling things stop earning. When earnings fall, the share prices fall. When share prices fall, the algorithms notice. Which brings us to problem 4. Problem 4. The machines are faster than anyone is comfortable admitting. 70% of all market trades today are executed by algorithms. Not monkeys making decisions, machines executing code. And these machines are not slow. They are not deliberating. They are responding in microseconds to signals that human monkeys cannot even perceive yet. This creates a specific and terrifying dynamic. When panic enters the market, the machines do not pause to assess whether the panic is rational. They execute sell orders. Those sell orders push prices lower. Other machines detect the lower prices as a fear signal. They execute more sell orders, which pushes prices lower, which triggers more machines. Marco has seen what this looks like. Flash crashes, 10% down in 20 minutes, for no fundamental reason. Pure machine reaction cascading into other machine reactions. And in a market already sitting on the 4 problems described above, that cascade does not need much to start. Here is where things get genuinely absurd, and frankly a little insulting. Because when markets struggle and portfolios bleed, the instinct of the financial establishment is not to examine the decisions made in boardrooms over the last decade. The instinct is to find someone else to blame. And that someone is usually Marco. Monkeys have seen this playbook before. The market is too volatile. Retail investors are irrational. Individual monkeys do not understand sophisticated financial products. The small investor is the problem. Sound familiar? Because this is the same logic that big AAA gaming studios use when they spend hundreds of millions of bananas making something nobody wants, and then blame the customers for not appreciating innovation enough. Different jungle, identical excuse. But here is what the data actually shows. The biggest systemic risks in 2026 were not created by Marco and his brokerage account. They were created by leveraged institutional positions, by corporate debt strategies designed to inflate short-term metrics, by a decade of monetary policy that encouraged risk without pricing it properly. Marco is not the architect of this situation. Marco is the monkey standing downwind of it. And the painful part is that Marco is the one who will feel the consequences most directly. Because the executives who made these decisions have golden parachutes. The algorithms have off switches. The institutional funds have hedges and insurance instruments built specifically for scenarios like this one. Marco has whatever he managed to save. Which is exactly why what Marco does right now matters so much. Here is the thing nobody explains properly in these situations, and it is important enough that Marco needs to read it slowly. Crashes do not destroy wealth. Crashes transfer wealth. From unprepared monkeys to prepared monkeys. From emotional monkeys to rational monkeys. From monkeys who panicked at the bottom to monkeys who were already positioned and waiting. This has been true in 1929, in 1987, in 2000, in 2008, and in 2020. Every single time, the money does not disappear. It changes hands. And the monkeys who received it were not lucky. They were ready. How Marco gets ready. Method 1. Inverse positions. Most monkeys only know one direction. Market goes up, investment goes up. Simple. Fine. But instruments exist specifically designed to profit from falling markets, called inverse ETFs. When the market falls 10%, these go up 10%. When the market falls 30%, these go up 30%. No complicated brokerage accounts needed. No borrowing. No margin calls. Marco buys like a normal share through any standard platform. Holds it. Collects profit from the falling market. SQQQ moves 3 times opposite to the technology index. SH moves 1-to-1 opposite to the general market. These are not exotic instruments. They are available to any monkey with a basic account and an understanding of what they are buying and why. This is not gambling. Marco is not flipping a coin here. Marco is looking at 4 concrete simultaneous problems in the real economy and positioning accordingly. That is called analysis. That is what the institutional monkeys with the golden parachutes do with their sophisticated instruments. Marco is doing the same thing with simpler tools. Method 2. The dividend harvest strategy that almost nobody talks about. When great companies fall in price during a crash, their dividend yield automatically explodes. This is simple mathematics that produces extraordinary results for the prepared monkey. Company pays 5 coins per year. Share currently costs 100 coins. Yield is 5%. Reasonable. Normal. Market crashes. Same company now costs 50 coins. Company still pays the same 5 coins per year, because the dividend is based on earnings, not on share price. Yield is now 10% automatically. Marco, who buys during the crash, locks in 10% annual return permanently, not for 1 year, For as long as Marco holds those shares, that entry price yield is locked in forever. Monkey, who bought quality dividend companies during 2008, is still collecting those payments today, every quarter, automatically. Like a banana tree that drops fruit on a reliable schedule regardless of what is happening in the rest of the jungle. The crash is not the disaster for this monkey. The crash was the opportunity this monkey had been patiently waiting for. Method 3. Gold positioning before the printing starts. Every single time a major crash arrives, Boss Monkey responds the same way. Prints more green leaves, floods the system with new money to stop the bleeding. This happened in 2008, happened in 2020. Will happen again because it is the only tool Boss Monkey reliably reaches for when things get bad enough. When new green leaves get printed, existing green leaves become worth less. Each one buys slightly less than before because there are simply more of them chasing the same amount of actual things. Gold does not get printed. Supply is fixed. When leaves lose value, gold gains value automatically because the relationship between them shifts. In 2008, gold rose 25% while the stock market fell 50%. Marco, who was already holding gold before the printing started, profited from the printing itself. Marco, who waited for the announcement, was already too late. The move always happens before the announcement. Always. Method 4. Go shopping when everyone else is running for the exit. Apple fell 60% in 2008. Was Apple going out of business? No. Did Apple have real products, real customers, real cash on the balance sheet? Yes. Was it caught in a wave of panic selling from monkeys who needed liquidity immediately? Also yes. Monkey, who bought Apple in early 2009, made 15 times his initial coins by 2015. Not 15%, 15 times. Amazon fell 93% during the dot-com crash. Monkey, who bought near the bottom, turned 100 coins into 50,000 coins over the next 20 years. These are not lottery tickets. These are the best companies in the world going on sale because emotional monkeys needed cash and had no choice but to sell regardless of price. Marco with dry powder walks in quietly while everyone else runs out screaming, loads the basket, waits. The crash is the sale. Marco was waiting for the sale. Preventing a loss is mathematically more powerful than earning an equivalent gain. Marco, who avoids losing 50%, does not need to earn 50% to recover. He is simply still standing when other monkeys are starting over from zero. First, remove leverage immediately. If Marco is currently using borrowed money to invest, today is the day to have an honest conversation with himself about what happens if the market falls 40% tomorrow morning. Because with 10 times leverage, a 40% market drop does not mean Marco loses 40% of his investment. It means Marco loses everything he put in, plus owes additional coins to the broker. The broker does not wait for things to recover. The broker executes a margin call, sells everything automatically at the worst possible moment. Nothing remains. Every monkey currently using leverage should ask one question. Can I survive being completely wrong about market timing for the next 18 months? If the answer is no, the position is too dangerous for the current environment. Reduce it, remove it, return to sleeping at night. Second, build the 3-bucket system before the storm. Not during, before. During is too late and Marco knows this. Bucket 1 is the emergency bucket. 6 months of living expenses in pure cash. Sacred, untouchable. When recession arrives and Marco's employer starts making decisions about headcount, Marco does not have to sell his investments at the absolute worst moment just to cover rent. He eats from bucket 1. Investments stay in place and recover on their own timeline. Monkey without this bucket makes the single most expensive mistake possible during a crash. Forced selling at the bottom because there is no alternative. Locking in permanent real losses from what was only temporary paper losses. Bucket 2 is the defense bucket. 40% of portfolio in assets that survive or even benefit from chaos. Gold, short-term government bonds, utility companies, consumer staples. Companies selling things monkeys cannot stop buying regardless of how bad the economy gets. Food, medicine, electricity. These assets fall less. Some rise. They are the boring trees that stay standing when the flashy trees collapse all at once. Bucket 3 is the opportunity bucket. Cash set aside specifically for buying during the crash. This bucket sits quietly right now, doing nothing useful. Waiting. When the market bleeds and the news screams and neighbor monkey is showing Marco his destroyed portfolio in the group chat, Marco opens bucket 3 and starts shopping for great companies at half price. This is the bucket that builds the kind of wealth Marco will still be talking about in 20 years. 3 buckets. Simple system. Disproportionate protection. Third, look inside what Marco actually owns. Most monkeys own funds and ETFs and have never actually looked at what those funds contain. Never checked the debt levels of the top holdings. Never asked whether these companies can comfortably survive 2 more years of elevated interest rates. One task for this week. Open every fund Marco owns. Find the top 10 holdings. Ask one question for each. If rates stay exactly where they are for 2 more years, does this company survive comfortably without needing to refinance at painful rates or cut its dividend or lay off significant staff? Companies with real earnings, low debt, products people need in a recession, those survive. Those recover fast when the smoke clears. Companies with borrowed growth, high leverage, products people cut immediately when budgets tighten, those get destroyed, and they drag the fund down with them. Marco, who does not check, is carrying hidden risk he has not priced into his thinking. The risk does not care whether Marco is aware of it. Fourth, close the application during the actual crash. This sounds too simple to matter. It is not. Yellow Monkey drew this scene perfectly. Marco refreshing his portfolio every 20 minutes during a falling market. Heart rate increasing with every red number. Fear building. Selling at the exact bottom because the psychological pain of watching the number fall becomes greater than the rational understanding that recovery will come. This is precisely how temporary paper losses become permanent real losses. The market has recovered from every single crash in all of recorded financial history. Every one, without a single exception. Marco, who held his portfolio through 2008 without touching it, was completely recovered by 2012, 4 years. Marco, who panicked, sold in October 2008, locked in his loss permanently, and then was too frightened to buy back in at the bottom because the news still looked terrible. The crash is not the enemy. The emotional reaction to the crash is the enemy, and the enemy lives inside Marco's phone. Set a monthly automatic investment. Close the application. Come back in 6 months. The monkey who manages to do this during the crash is the monkey who looks back a decade later and says it was obvious what to do. It was just hard to do it while it was happening. Look, the 4 problems described in this video are not predictions from a cartoon. They are current, measurable, real data points sitting in public financial disclosures that anyone can read. Debt levels, default rates, consumer delinquencies, algorithmic trading percentages, all documented, all available, all pointing in the same direction simultaneously. Most monkeys see this information and feel one of 2 things: denial first, then, when denial becomes impossible, panic. And panicking monkeys make the most expensive decisions of their financial lives. But Marco is not most monkeys. Marco watched this entire video. Marco now knows what the 4 problems actually are and why they matter. Marco knows how to position to profit if things go badly. Marco knows how to build 3 buckets before the storm arrives. Marco knows which assets survive and which ones get destroyed. Marco knows to close the application when the numbers start falling. The difference between the Marco who loses everything in this crash and the Marco who comes out the other side significantly wealthier is not intelligence. It is not luck. It is not timing. It is what Marco does in the next 30 days before the next domino falls. The signs are already on the ground. Fresh, clear. The monkey who reads them walks calmly. The monkey who ignores them runs in circles when the fire starts. Marco knows which monkey he wants to be.